Welcome back to WealthWise, the podcast where clarity meets actionable strategy for your financial future. I'm your host, Sarah. One question seems to be on repeat in countless conversations I'm having lately, and I bet it's on your mind too. With mortgage rates still hovering at levels that make our wallets wince, will we ever see a 5% mortgage again? It feels like a lifetime ago, doesn't it? Well, today, we're not just going to ask that question, we're going to dissect it. We're diving deep into the often murky waters of mortgage rates, specifically the 5% mortgage, a distant dream or an achievable reality in today's new economic landscape. And by the end of this episode, our goal is for you to walk away with a much clearer picture. You'll understand, 1, the 2 critical factors that could genuinely pave the way for mortgage rates to dip back to that 5% mark, or perhaps even lower. 2, how the big picture decisions from institutions like the Federal Reserve and even global events like trade tariffs actually translate into the numbers you see and the impact on your personal finances. And most crucially, what intelligent, actionable steps you can and perhaps should be considering right now in this very real high-interest environment. To help us navigate this complex terrain, I'm absolutely thrilled to have an incredibly sharp mind with us today. He's a seasoned financial analyst, the insightful founder of the widely respected Market Briefs newsletter, and a true expert when it comes to decoding these powerful macroeconomic forces. Please welcome to WealthWise, Max Wise. Max, thanks so much for being here.
Sarah, it's a real pleasure to be here. Thanks for having me. And you've hit the nail on the head. This is a topic that's generating a tremendous amount of anxiety and, frankly, a sense of paralysis for a lot of people. It's a great question, and I think the misunderstanding stems from a few key areas. Firstly, there's the sheer emotional weight of it all. Home ownership is such a significant milestone, a cornerstone of the American dream for many. So when borrowing costs are high, it doesn't just feel like a financial spreadsheet problem. It feels deeply personal. This leads to what I often see as a kind of herd mentality mixed with wishful thinking. People see these persistently high rates, and one camp resigns themselves to the idea that this is just how it is now, forever, which can lead to inaction or despair. Then there's another camp fervently hoping for, almost expecting a swift return to the ultra-low rates we saw in the recent past, often without a full appreciation of the complex economic shifts that would need to occur for that to happen. It's that classic push and pull between fear of the present and a sometimes unrealistic hope for the future. Secondly, there's a significant and very common misunderstanding about the Federal Reserve's direct role. Many people believe the Fed just flicks a switch and mortgage rates magically go up or down. While the Fed's policies are undeniably influential, they set the federal funds rate, which is essentially the interest rate at which banks lend to each other overnight. It's not a direct one-to-one translation to the 30-year fixed mortgage rate you see advertised. That rate is also influenced by investor demand for mortgage-backed securities, the overall economic outlook, inflation expectations, and a risk premium that lenders build in. So it's a much more layered process than just what did the Fed do this week. And thirdly, Sarah, let's be honest. The economic data itself can be incredibly noisy and often feel contradictory. One month we hear inflation is cooling, the next a jobs report comes out stronger than expected, suggesting the economy is still running hot. For the average person trying to make a huge life decision like buying a home, sifting through these seemingly mixed signals to find a clear path forward is a Herculean task. It breeds uncertainty, and uncertainty often leads to inaction or worse, decisions based on incomplete information.
That's such a clear breakdown, Max. Can you give us a real-world example or maybe a common scenario you've encountered that really illustrates this confusion?
Absolutely. A perfect example is the current situation with inflation and the Fed. We've seen inflation, as measured by the CPI, come down significantly from its peak. That's objectively good news, and many people logically think, okay, inflation is down, so rates should follow suit quickly. But the Fed is looking at a target of 2% sustained inflation, and we're still stubbornly above that. So they're maintaining a cautious, higher-for-longer stance. It's like they're trying to gently guide a massive ship, and they can't make sudden, jerky movements without risking broader economic instability. For someone waiting on the sidelines, this cautious Fed approach can feel frustratingly slow when all they see is the headline, "Inflation is falling." Another scenario I see constantly, particularly with younger, first-time homebuyers, is this waiting game based on rate predictions. I've spoken with countless individuals, bright, ambitious people in their late 20s or early 30s who have solid jobs, good savings habits, but they've put their home buying aspirations on indefinite hold, telling me, "I'm just waiting for rates to hit 5% again." Now, patience can be a virtue in finance, no doubt, but the challenge here is that this indefinite waiting can mean they miss out on a property that, even at current rates, might be a sound long-term financial move for their specific situation. Perhaps it's in an area with strong growth potential, or maybe prices have softened a bit, creating an opportunity. They become so fixated on this one variable, the interest rate, that they might overlook other crucial factors in the equation. They're essentially letting one piece of the puzzle dictate their entire strategy, often based on hope rather than a holistic assessment of their own financial readiness and the broader market dynamics. And that's precisely why it's so vital to move beyond just the headline numbers and understand the underlying drivers. It's not about finding a crystal ball to predict the exact future of rates, but about grasping the why behind the current environment. Because once you understand those core mechanics, you're empowered to make decisions that are right for you, regardless of which way the wind seems to be blowing on any given day. This actually sets us up perfectly to start unpacking those core insights you mentioned earlier, Sarah, to really get into the nuts and bolts of what could genuinely move the needle on these rates.
Okay, Max, you laid out a fantastic foundation for why this topic is so complex. You mentioned earlier that there are essentially two major paths that could lead us back to that more palatable 5% mortgage rate, or even lower. The first one you highlighted was time. It sounds simple, but I know there's a lot packed into that. Could you really unpack for us the different facets of time, specifically how inflation, those often talked about tariffs, and even the leadership at the Federal Reserve itself all play a role over time in shaping where mortgage rates might head?
Absolutely, Sarah. Time isn't just about passively waiting. It's about specific economic and political processes unfolding. Let's break it down into those three key components you mentioned. First, and arguably the most dominant factor right now, is inflation. As we've discussed, the Federal Reserve has a very clear mandate to maintain price stability, which they currently define as a 2% inflation rate. We've made progress. Inflation has fallen from its recent scorching highs, but we're still hovering above that 2% target. Think of the Fed as a physician trying to bring a patient's fever down. They've administered some strong medicine, higher interest rates, and the fever is receding, but it's not gone. So the Fed is essentially saying, we need to keep interest rates higher for longer to ensure inflation is truly and sustainably back to our 2% goal. Only when they see consistent data confirming that inflation is tamed will they feel confident enough to start lowering the federal funds rate. And as that wholesale rate for banks comes down, it creates the room for mortgage rates to follow. So time, in this context, is the period needed for these restrictive policies to fully work their way through the economy and demonstrably cool price pressures. It's a delicate balancing act. They don't want to tip the economy into a deep recession by being too aggressive, but they also can't let inflation become entrenched. For example, if we see several more months of core inflation readings coming in at or below, say, 0.2% month over month, that would be a very strong signal that time is doing its work, and the Fed might start signaling a pivot.
That makes sense. It's not an instant switch.
Exactly. Now, the second component of time relates to tariffs, or taxes on imported goods. This is a bit of a wild card, Sarah, because it's heavily influenced by geopolitical factors and trade policy, which can be less predictable. The concern here is that if significant new tariffs are imposed or existing ones are escalated, it can directly increase the cost of a wide range of goods for consumers and businesses. This, in turn, can reignite inflationary pressures, essentially working against what the Fed is trying to achieve. The Federal Reserve has explicitly stated that tariffs could make the inflation problem worse. So if we see a scenario where, let's say, new broad-based tariffs are implemented on goods from major trading partners, that could complicate the Fed's job immensely. It might force them to keep rates higher for even longer to counteract this new inflationary impulse. Conversely, if trade tensions ease, or if planned tariffs are less aggressive than anticipated, for instance, we're watching some key dates like July 8th for potential developments, that could give the Fed more ammunition, as they say, to consider cutting rates sooner, because the risk of tariff-induced inflation would be diminished. So time here is about seeing how these trade policies actually materialize and what their real-world impact on prices is. It's like waiting for the weather forecast to become more clear before planning a long trip.
A very unpredictable element, then. And the third aspect of time?
The third aspect, and this one is more of a long-term consideration, has to do with the leadership at the Federal Reserve itself, specifically the chair. The Federal Reserve is designed to be an independent institution, insulated from short-term political pressures. The President of the United States can't simply fire the Fed chair. However, the chair serves a specific term. Jerome Powell's current term as chair is set to end in May 2026. At that point, the sitting president will have the opportunity to either reappoint him or nominate someone new. Now, different individuals can have different leanings or philosophies when it comes to monetary policy. Some might be more hawkish, meaning they prioritize fighting inflation even at the cost of slower economic growth, or they might be more dovish, meaning they might be more inclined to cut interest rates to support employment and growth, even if inflation is a bit above target. We've seen in the past where a change in Fed leadership, or even the anticipation of it, can shift market expectations. So if, as we approach 2026, there's a prevailing view that a new Fed chair might be more inclined towards a looser monetary policy, that could, over time, influence market sentiment and potentially interest rates. It's not an immediate effect, but it's a structural factor that plays out over a longer horizon. Think of it like baking a complex cake, Sarah. You can't just crank up the oven to full blast to make it bake faster. It needs the right temperature for the right amount of time, with all the ingredients interacting correctly. Monetary policy and its effect on things like mortgage rates is very much the same. It requires patience and an understanding that these multifaceted processes need time to unfold.
So it's crystal clear. Time isn't just about passive waiting. It's about the deliberate unfolding of crucial economic and policy dynamics.
That's a really comprehensive look at the time factor, Max. Now, the second major element you mentioned that could potentially bring mortgage rates down is something that frankly sounds a lot more ominous: an economic recession. It feels counterintuitive, almost like wishing for bad news. Can you explain how a recession, despite its negative connotations, might actually pave the way for more affordable mortgage rates? And what are the historical precedents for this?
It absolutely sounds counterintuitive, Sarah, and no one should be actively rooting for a recession, as they bring widespread economic hardship, job losses, and a lot of pain. However, from a purely mechanical perspective of interest rate movements, history has shown us a very consistent pattern. When the economy significantly contracts, when we enter a recession, the Federal Reserve generally steps in to cut interest rates, often aggressively, as a way to stimulate economic activity. Let's look at some historical examples to make this tangible. After the dot-com bubble burst in the early 2000s, the economy slowed, and the Fed, under Alan Greenspan at the time, cut interest rates a remarkable 11 times between January 2001 and June 2003, bringing the federal funds rate down from 6.5% to 1%. Fast forward to the Great Financial Crisis of 2008, the housing market collapsed, credit markets froze, and the economy plunged into a severe recession. In response, the Fed, then led by Ben Bernanke, slashed interest rates dramatically, eventually taking the federal funds rate to near zero, effectively 0 to 0.25%, where it stayed for several years. This was an unprecedented move aimed at reviving lending, spending in the overall economic system. And more recently, during the COVID-19 pandemic in 2020, as the global economy went into lockdown and faced an abrupt, severe shock, the Fed once again acted decisively, cutting rates back down to that near-zero level almost overnight to provide support and liquidity to the markets in the economy. The underlying mechanism is fairly straightforward. When an economy is shrinking, businesses cut back on investment and hiring, consumers reduce spending, and overall demand plummets. In such an environment, the Fed's primary concern shifts from fighting inflation to preventing a deeper, more prolonged downturn and stimulating growth. Lowering the federal funds rate, that wholesale interest rate we talked about, makes it cheaper for banks to borrow money from each other. This in turn enables banks, though it doesn't force them, to offer lower interest rates to consumers and businesses for things like mortgages, car loans, and business loans. The idea is that cheaper borrowing costs will entice people and companies to start spending and investing again, thus pulling the economy out of the recession. Now, a very important clarification, Sarah, because this is a common point of confusion. If the Fed cuts the federal funds rate to zero, does that mean your mortgage rate will be zero? Absolutely not. Remember, the federal funds rate is what banks charge each other. When you go to get a mortgage, the bank is going to charge you that wholesale rate plus a spread. That spread covers their operational costs, their profit margin, and crucially, the risk they are taking by lending you money for 30 years. So even in a zero interest rate environment set by the Fed, mortgage rates will still be significantly above zero. However, a lower federal funds rate certainly puts downward pressure on mortgage rates. One more critical point I always try to emphasize, Sarah, because this is common. Just because the Fed is cutting rates to stimulate the economy, it is not your patriotic duty as a citizen to go out and load up on debt. Your personal financial health and stability should always come first. It's better for you to be smart with your money, manage your debt wisely, and build a resilient financial foundation, rather than overextending yourself just because borrowing costs are temporarily lower. The Fed actions are macroeconomic tools. Your financial decisions should be micro, focused on your own well-being.
That's a vital distinction, Max. The personal responsibility aspect is key.
Precisely. So, to bring it back, yes, a recession is historically one of the most powerful catalysts for significant interest rate cuts from the Fed. We know recessions are a recurring feature of the economic cycle. Looking at U.S. history over the last century, we've averaged more than one recession per decade. In fact, over the last 100 years, the United States has experienced 16 recessions. So we know they happen, we just don't know when the next one will occur. Right now, if you look at some of the headline data the Fed is watching, like the unemployment rate, it's still statistically very low. This suggests a strong labor market, which gives the Fed less ammunition to cut rates, because from their perspective, the economy doesn't appear to be in immediate danger of a sharp downturn. Of course, we know there are nuances. Many people are working jobs they're overqualified for or not earning what they feel they're worth, and many are struggling with debt. But the Fed looks at broad indicators. If those indicators start to weaken significantly, if we see a sustained rise in unemployment, a sharp drop in consumer spending, or a contraction in business investment, that would be the kind of data that could push the Fed towards rate cuts, even if inflation isn't perfectly at 2%.
A recession can indeed lower borrowing costs, but betting your financial future on an economic downturn is a high-stakes gamble you shouldn't make.
Max, this has been incredibly insightful, painting a clear picture of the big forces at play. So let's bring this down to the ground level for our listeners. We have the time factor, with its various components slowly working their way through the system. We have the potential, though undesirable, catalyst of a recession. But right now, today, the Federal Reserve is still maintaining a fairly hawkish stance on inflation. And as you said, some key economic data points like the job market still look relatively stable on paper. Given this current, somewhat uncertain landscape, what concrete, actionable advice would you offer to someone who is actively considering buying a home or perhaps feeling stuck by the current interest rates?
This is where pragmatism and personal financial discipline become paramount, Sarah. It's about navigating the current reality, not just wishing for a different one. My advice boils down to a few core principles. First, and this is non-negotiable, only buy a home that you can genuinely afford right now based on current interest rates and your current financial situation. Do not under any circumstances, buy a house based on the assumption or hope that you'll be able to refinance into a much cheaper mortgage rate in a year or two. That is a dangerous gamble that has cost people their homes and their fortunes in past cycles. You need to be able to comfortably afford the down payment, the monthly mortgage payment, principal, interest, taxes and insurance, PITI, and the move-in costs, plus have a healthy emergency fund left over. If stretching to make the numbers work today relies on a future rate drop, you're setting yourself up for potential financial distress. Run the numbers rigorously. Use a mortgage calculator. Be brutally honest with yourself about your budget. If the numbers don't work comfortably today, it's okay to wait, save more, or look at more affordable options. For example, I recently worked with a young couple. They were pre-approved for a loan amount that, on paper, they could handle. But when we dug into their actual monthly cash flow, considering their other savings goals, lifestyle, and a buffer for unexpected expenses, taking on that full mortgage amount at current rates would have left them house poor, with very little breathing room. We worked through a scenario where they looked at slightly smaller homes or homes in an adjacent, more affordable neighborhood. It meant a small compromise on their dream home vision, but it gave them financial security and peace of mind, which is invaluable.
That's such a critical point. Affordability today, not hoped-for affordability tomorrow.
Exactly. Second, especially in the early years of homeownership in a higher rate environment, it can be helpful to initially view your home more as a place to live, a primary residence liability, rather than an immediate wealth-building asset. Now, over the long term, real estate has historically been a great way to build wealth. But in the short term, particularly when interest costs are high, a significant portion of your early mortgage payments goes towards interest rather than building equity. If you go into home ownership with the mindset that this is primarily a home, a place for stability and to build your life, rather than a speculative investment that needs to appreciate rapidly, it can reduce a lot of financial and emotional pressure. This mindset also allows you to continue focusing on other wealth-building strategies, like consistently investing in your retirement accounts or other diversified investments, rather than putting all your financial eggs into the single basket of your home's immediate equity growth. Third, and this applies to all financial decisions, but is especially pertinent in volatile markets. Think like a long-term investor, not an emotional reactor. The financial news cycle is relentless. There will always be headlines, always be predictions, always be someone saying rates are going to the moon or crashing to zero. If you let your emotions get whipsawed by every news report, you'll likely make poor decisions. Instead, focus on what you can control: your savings rate, your spending habits, your debt levels, and your long-term financial plan. When it comes to buying a home, this means doing your due diligence. Don't just look at the interest rate in isolation. Is the price of the home fair for the current market and its condition? Is the location desirable with good schools, amenities, or job prospects that align with your long-term plans? Is your own financial situation robust enough to handle the payments for the foreseeable future, say the next 3 to 5 years, even if rates don't fall significantly in that time frame? Have you accounted for all the costs of homeownership beyond the mortgage, maintenance, repairs, potential property tax increases? For instance, if you find a home that ticks all these boxes and it fits comfortably within your current budget, then even if the interest rate is higher than you'd ideally like, it could still be a sound long-term decision. You can always explore refinancing options if and when rates do eventually come down, but the decision to buy should be based on the fundamentals of the property and your personal financial stability, not solely on chasing the lowest possible interest rate. Build your strategy around facts and your own circumstances, not fear or FOMO, the fear of missing out.
A wise home buying strategy focuses on what you can control today, your budget and the fundamentals, not on what you hope the market might do tomorrow. Max, your insights on navigating the current market have been incredibly valuable, really emphasizing that practical, grounded approach. And it makes me wonder, because we learn so much from experience, sometimes painful experience. In your own financial journey, particularly as you've observed and analyzed these markets for so long, was there a specific moment, perhaps a misstep you made or witnessed up close, or a significant breakthrough related to interest rates, real estate, or market psychology that fundamentally changed how you view these challenges and opportunities? A story that really crystallized some of these lessons for you?
Oh, absolutely, Sarah. There are always moments, but one period stands out quite vividly, and it was a crucible that shaped a lot of my thinking. It was in the run-up to the 2008 financial crisis. I was younger then, an analyst, deeply immersed in the markets, but perhaps not with the same degree of healthy skepticism I carry now. There was this pervasive, almost intoxicating narrative at the time: housing prices only go up. It was repeated so often from so many seemingly credible sources that it almost became an unquestioned truth. And coupled with that was the idea that interest rates will always be manageable, you can always refinance to a lower rate. It created this environment of, I can only describe it as collective euphoria, almost a suspension of disbelief. I witnessed people I knew, friends, even some clients I was peripherally involved with through the firm I was at, making decisions that, in hindsight, were incredibly risky. They were stretching themselves financially to an extreme degree, buying much more house than they could realistically afford, often with little to no down payment, using exotic loan products with teaser rates that were bound to reset significantly higher. The rationale was always, I'll just refinance in a year or two when rates are lower or when the house has appreciated enough. It was like a game of musical chairs, and everyone assumed the music would never stop. And if I'm being completely honest, Sarah, while my analytical brain flagged some of these excesses, the sheer momentum of the market, the optimism, it was hard not to get caught up in it to some degree. I don't mean I personally made reckless investments, but I perhaps wasn't as vocal or as forceful in cautioning some individuals as I might be today. There's a difference between a quiet internal analysis and actively trying to swim against a very powerful tide of popular opinion. I remember feeling a sense of unease, a sort of cognitive dissonance, but the prevailing wisdom was so strong. Then, of course, the music did stop, and it stopped brutally. When the housing market turned and those adjustable rate mortgages began to reset at much higher rates and property values started to plummet, the fallout was devastating. I saw people lose their homes, their savings, their sense of security. It was a deeply humbling and, frankly, painful period to witness, even from an analyst's perspective, because these weren't just numbers on a spreadsheet, these were real lives being impacted. The breakthrough for me, or perhaps the scar tissue that formed, was a profound, almost visceral understanding of two things. First, never, ever underestimate the power of herd mentality and the danger of widely accepted truths that lack a solid fundamental underpinning. Just because everyone is saying something doesn't make it true. In fact, when consensus becomes that overwhelming, it's often a signal to be extra cautious. The market can remain irrational longer than you can remain solvent, as the saying goes. And second, and this is something I preach constantly now, a rock-solid personal financial foundation, a robust emergency fund, manageable debt levels, a diversified investment portfolio, and a clear understanding of your own risk tolerance is infinitely more important than any prediction about where interest rates or markets are headed. You can't control the Fed, you can't control global economic events, but you can control your own savings rate, your spending, and your preparedness. That period, witnessing the fallout, it stripped away any lingering naivete about market infallibility. It taught me the profound importance of risk management, of stress testing assumptions, and of always, always grounding financial decisions in reality, not in hope or hype. That's why I'm so passionate now about financial education that empowers individuals to think critically and build resilience rather than just chasing the latest trend or trying to time the market. That experience, as difficult as it was to observe, became a cornerstone of my financial philosophy.
Wow. Max, thank you for sharing that so candidly. That's an incredibly powerful and sobering account, and the lessons you drew from it are just universal. That emphasis on personal financial fortitude above all else really resonates.
Max, drawing on that wealth of experience and your deep understanding of these market forces, if you were to look ahead, say over the next 3 to 5 years, And you had to bet on one significant shift or trend that will most define financial success, particularly as it relates to navigating the housing market, interest rates, and personal investment. What would that be?
That's a great question, Sarah. And if I had to pinpoint one overarching trend, I believe it would be the resurgence and critical importance of intentional financial discipline as a primary determinant of success. Let me explain what I mean by that. For much of the last decade, we lived in an era of exceptionally, almost artificially, low interest rates. This environment, in some ways, papered over the need for rigorous financial discipline for some. When money is cheap and asset prices are broadly rising, it's easier to feel financially secure, perhaps even to make less than optimal financial decisions and still come out okay. Saving diligently might have felt less urgent when your investment portfolio or home equity was seemingly doing the heavy lifting. Budgeting might have seemed less critical when credit was so readily available at low costs. However, as we've discussed, even if interest rates do come down from their current highs in the next 3 to 5 years, it's unlikely we're going back to that near-zero free money era anytime soon. The structural inflationary pressures, demographic shifts, and geopolitical realities suggest that the cost of capital will likely remain more normalized, meaning higher than what we got accustomed to. What this means for individuals is that the fundamentals of personal finance will matter more than ever. For homebuyers, success won't just be about finding the right house. It will be about having meticulously planned their finances, saved a substantial down payment, and truly understood the long-term affordability of their mortgage in a potentially higher-for-longer rate environment. Those who have diligently managed their debt-to-income ratios and built strong credit profiles will have a distinct advantage. For savers and investors, the ability to consistently save, to live within one's means, and to make disciplined long-term investment choices, rather than chasing speculative returns, will be crucial. Passive income streams built through consistent saving and prudent investing will become even more valuable. We might see a greater appreciation for strategies that focus on cash flow generation and value, rather than just pure growth at any cost. Innovation in financial products. I also anticipate we'll see an acceleration in financial products and services that cater to this need for discipline and flexibility. For instance, in the housing market, we might see more creative financing solutions, perhaps more sophisticated shared equity models, or platforms that make fractional ownership of real estate more accessible and transparent, helping people get a foot on the property ladder in a more manageable way. Technology, particularly AI, will likely play a role in providing more personalized financial planning tools that help individuals stick to their budgets and savings goals. Essentially, Sarah, the easy mode of the last decade, fueled by ultra-low rates, is likely over. The next 3 to 5 years will reward those who are proactive, disciplined, and strategic in managing their personal finances. Financial success will less be about riding a general market wave and more about building a sturdy, well-navigated ship. It's a return to the timeless principles of sound money management, but amplified by the current economic realities.
A return to fundamentals, a focus on intentionality. That's a very compelling forecast, Max. It underscores that personal agency is really key, regardless of what the broader markets are doing.
Max, this has been an absolutely phenomenal conversation. From dissecting the intricacies of interest rates and the Fed to sharing your personal experiences and offering that forward-looking perspective on financial discipline, I know our listeners have gained an incredible amount of clarity and actionable wisdom today. Thank you so much for your time and your generosity in sharing your expertise with the WealthWise community.
The pleasure was all mine, Sarah. Thanks for having me. These are important conversations to be having.
Absolutely. And to everyone listening, if today's deep dive into mortgage rates and financial strategy resonated with you, if you found value in Max's insights, here are 3 simple things we'd love for you to do. 1, share this episode. Think of one person, a friend, a family member, a colleague, who's navigating these questions about homeownership or their financial future. Send it their way. A little bit of clarity can go a long way. 2, Subscribe to Wealthwise wherever you get your podcasts. We bring you these kinds of in-depth conversations every week, designed to help you build not just wealth, but wisdom. Hit that subscribe button so you don't miss out on future breakthroughs. And finally, we'd love to hear from you. What was your biggest takeaway from today's conversation? Do you have follow-up questions for Max or future topics you'd like us to explore? Drop us a comment or review on your podcast platform, or connect with us on our social channels. Your feedback genuinely helps us shape the show. This journey of building financial well-being is a marathon, not a sprint. It's about making informed decisions one at a time, grounded in understanding and strategy. Thank you again for tuning in to Wealthwise. And always remember this: financial freedom isn't just a distant dream. It's a series of deliberate choices consistently made. Until next time, take care and build wisely.